Singapore Investment Week has undergone a change in 2015. It's no longer just 1 week. It's in fact multiple seminars throughout the year. Multiple Singapore Investment Weeks, you could say. Go to the website on the screen to find out more. One of the presenters on the 9th of May is Scott Connor from thinkorswim. And over the last couple of years, Scott, we've talked to you in your capacity as Director of Education about how to use options, for example, to enhance the value of your portfolio. Why don't we today focus a little bit more tightly on active versus passive investing and the sort of strategies that you can employ. Firstly, what is the difference between active and passive?
Good, absolutely. Well, first of all, it's a pleasure to be back again and seeing you all again, and looking forward to the SIAS event coming up May 9th. Yes, so the themes this year is about passive versus active investing. And there is a little bit of confusion about that, but a simple way to look at it is if you are a stock picker, right? In other words, you think you can beat the overall market return by picking just the best stocks and the winners, that would be active investing. Passive investing is more like saying, okay, I have X amount I want to invest in the market, but I'd rather pick a diversified, broad-based portfolio of stocks that I know historically have been winners, so to speak. In other words, solid companies with good fundamentals and good earnings growth and dividends, et cetera, et cetera. But just can someone package that all for me together so I don't have to individually try to pick the winners? And by going into a product like that, now you're letting someone else pick that diversified portfolio for you and just make one trade or one execution, and now you've got that investment yourself.
So active investing requires stock picking, I suppose, by the investor.
Yes, it does.
What sort of products are available for passive investors?
So for passive investors, there are several products, but one of the most popular products right now worldwide, particularly in the US markets, are exchange-traded funds. And you hear the acronym ETF all the time. Well, that's exactly what that stands for, exchange-traded fund. Now, they are very broad diversified. Some are based on certain sectors of the market, but there are 4 or 5 very broad-based exchange-traded funds, like the DIA, which is the Dow Jones Industrial Average, another one called the SPY, which is the S&P 500, which is probably the benchmark for the US market. So those are 2 of the very popular ones. Another one called QQQ, which is the NASDAQ. And of course, that's also very popular.
Yes, but what about the mutual funds, unit trusts? In a sense, they're passive because as an investor, you don't have to make any buying decisions.
Right.
But there's still an active fund manager behind that. So is that considered active or passive?
Right, so mutual funds, and again, why did ETFs become popular? Well, because the mutual funds are passive in a certain way. However, they do have managers of these mutual funds. And they use their expertise to, at the same time, pick certain stocks for you. So they kind of work both ways. They've got a portfolio of stocks, but they also like to pick their winners. Why? Because they want to beat the benchmark of the S&P 500. So if the market's up this year 11%, the S&P 500 is 11%, they look to beat that number. Now here's the interesting fact. They'll use their expertise to pick stocks to try to beat that 11% number, but articles I've read recently have shown that almost 80% of them do not beat the S&P 500. Now, why should you care? Well, the mutual funds will charge you for that expertise. So in the price of getting into a mutual fund, you're paying close to 1% a year in the management fees. Now, if they're not even beating the S&P 500, why not do it yourself? And that's why the importance and the popularity of ETFs has grown, because you can do it yourself for 1/10% management fee. Does that make sense?
Yes, except it's then no longer active, is it? I mean,
Correct.
An ETF is simply looking at the index and saying, we're going to track the index.
Absolutely. So the ETF will say, let's pick one, for example, the DIA, which is the ETF based on the Dow Jones Industrial Average. That is the 30 stocks in the Dow Jones. Just like the local ETF, STI, the Straits Times Index, that's the 30 biggest stocks in Singapore, right? So you have the same kind of concept where those 30 stocks are fixed. Now, they do occasionally change maybe 1 or 2 members of that, but it's very, very rare when they do that. So those stocks are already picked for you. So absolutely, it's passive. Once you purchase the ETF of the DIA, the Diamond, you get actually all 30 of those stocks, and you don't have to do anything. It's done for you.
Yes. Okay. Scott, here's a question which I know you'll laugh at, but I'm sure you get this question all the time.
Sure.
Passive versus active, which one's better?
Which one is better? Well, if you ask the people who are active, they'll say that active is better.
But well, you've just told us that 80%
but the
of them
facts,
don't
exactly.
meet the index.
The facts don't do that. They don't back that up. You're right. So why should I pay a manager, or an expert manager, 1% of my portfolio every year if 80% of them don't beat the passive ETF? So my answer obviously is the passive ETF, right? Absolutely. I think as an investor, learning about the ETFs, finding the ETFs that fit your portfolio, that's exactly the route to go.
Yes. I suppose the counter argument, though, would also be that it's a bit boring to be in an ETF. All the ETF does is track the market. It never underperforms the market, but it never outperforms the market.
Correct. Absolutely. And that's not a bad thing, because historically, if we look at the returns of the market over the last 100 years have been, about 7% a year, excluding dividends, right in that range, which is not a bad return, right? Because then, with using the rule of 72, you're doubling your money, about every 10 years, something like that, which is not a bad thing. But the question then becomes, well, are there other things I can do to enhance the returns of my ETF? And again, that's sort of a different topic, but that's what makes it interesting. So if you want to take the ETF, which is passive and has a long-term track record of good returns, is there a way I can slightly increase the returns on that? And actually there is. There are certain option strategies we can now apply to the ETFs to increase or enhance the returns of that ETF. Now, we're not talking big amounts. I mean, we're shooting for just maybe 0.5% a month. And you might think, well, 0.5% a month, that doesn't sound too sexy to me, right? I mean, that's not too exciting. But 0.5% a year times 12 months is 6%. So now if we can take that average 7% annually, add 6% to it, we're talking about a 13, 14% return annually, and that is a fantastic annual return.
Even when interest rates rise, I assume.
Absolutely, right.
Do you expect much of a change to the market once interest rates go up?
Well, yeah, that's to be seen and be determined. The question is, there's so many countries right now that are actually lowering rates. It's a lot of pressure on the U.S. to maybe not step it up as fast. And we're watching our economy very closely. But once rates start to go up, we do expect to see a little back off in the market. So but that sort of brings up one other idea about the ETFs. Passive as they are, there are option strategies you can use to actually protect a portfolio as well. So that's the neat thing about using the ETFs. They all have additional options that trade with them, as opposed to the mutual funds that we spoke about earlier.
Yes. Okay, and by the way, you can still find our previous interviews with Scott over the last 2 years on YouTube, in fact on the channel that you're currently on. So look out for some of those previous interviews, because they still hold a lot of value in terms of what you can do with options. Let's offer something fresh and zoom into one particular strategy that you're here to talk about, where you are also still picking stocks, but you are finding ways to protect the value of your investment if, let's say, there is another economic downturn or interest rates rise or whatever the question is. What is that new strategy that you're here to talk about? Okay, well, actually there's two, if I may. One of them is protecting that portfolio. So even though we just spoke about the benefits of having a passive ETF, which is a broad-based index, there are still many people who like to pick stocks. Now, there's nothing wrong with having a broad-based indice like an ETF, and also adding some of your particular individual stocks. Some people are very stubborn and say, no, I've always picked my stocks, I want to continue to pick my stocks. And so what about those people? Well, there's two things I'd like to mention. One is that many people don't realize that if you're picking your own stocks, and you've basically created your own portfolio, your own personal ETF, if you will, there are ways you can enhance that as well. Because thinkorswim has actually a function on the trading platform that will take your entire portfolio of stocks and beta weight that entire value of those stocks against the major or the biggest ETF, which is SPY, which is the S&P 500. So what it essentially does, it takes your portfolio of individual stocks, turns it into the equivalent shares of SPY, the broad-based ETF, and then with that, you can now add an option strategy to increase the returns or enhance the returns using a covered call strategy. So that's one thing that most people don't even realize. No, and hang on, before our eyes glaze over, I'm going to have to take you back a step. You called it beta weight? What does that actually mean? Beta weighted. So what it does, it takes each of your individual stocks. Let's say you have Apple and Baidu and Google and General Motors, all these different stocks. It takes each individual stocks, gives it a value as though it were the equivalent number of shares of SPY. So let's say you had $1 million portfolio of individual different stocks. We will tell you exactly what the equivalent of that is in SPY shares. Now that you've determined that, you can use SPY with one trade to hedge that whole portfolio of the various stocks you have. So a very unique feature that you can use to actually enhance the returns using options. Beta usually refers to fluctuations in prices. So can you help us understand a little bit more about what beta weight means? So the way they beta weight, they take each individual stock and they say, okay, this stock, every time the S&P 500 moves $1, this stock tends to move
80 cents, right? So that's how they beta weight the stock. So they'd take a stock that only moves 80 cents and give that a slighter lower weighting, or higher rating, so as opposed to a stock that moves more than the S&P, they'll actually bring that back down to match the 1. Okay, so basically it's kind of a complex formula, but it's all in the software. You don't have to worry about it.
Right, so you just click and
you just
do the
click
beta
and
weighting
put it in,
that's
click beta weight.
And so what benefit is that then to you? What can you do with that information?
Okay, so once you have that, that's one. So now you know the equivalent SPY delta, if you will, or SPY position of your portfolio, which number one lets you now enhance returns of that portfolio. Secondly, that we spoke to earlier, you can also now protect that whole portfolio using the S&PY options to protect against a big downturn. Okay, now that involves a put strategy where we'll actually be looking to buy long-term puts, and then if the market starts to drop, you'll be making money on the puts as your portfolio stocks go down. So basically side by side, and actually you can prevent losses, a good portion of your losses on the way down.
Because the value of the puts rises as the value of your portfolio falls.
Exactly.
Right.
So exactly. So if we can balance the right number of puts against the number of individual stocks we have, as the stocks go down, the value of the put should be going up incrementally about the same.
So in essence, you're creating your own ETF based on the stocks in your portfolio. But what if you've made the wrong pick? And I suppose even if even the fund managers underperform the index 80% of the time,
Correct.
then we're bound to have some lemons in our portfolios. What happens if your own ETF kind of, you pick some of the wrong ones?
Well, that's going to be bound to happen. And again, if it happens to the best managers in the world, it's going to happen to you as well. And that's one of the difficult parts about picking individual stocks. When you do pick individual stocks, you're always exposed to what we call event risk, right? So individual stocks can have news that comes out, like earnings don't meet, for example, or they have to restate earnings. These are all the kinds of things that can just decimate a stock price overnight, as you've seen. Well, when you're in a broad-based portfolio, like the S&P 500, the SPY, there's 500 stocks in it. Now, again, these are the highest quality stocks. So yeah, one or two of them might have some bad news like we spoke, but that doesn't really affect the overall value of that whole portfolio since it's so broadly based and diversified. So that's one way, is to avoid event risk is actually being in the ETFs. Now, what if something in your portfolio goes down? Well, again, that's the risk of picking your own stocks. If they're not the big broad-based blue chips that are included in these ETFs, well, that's definitely a risk you take. Again, you can protect with puts, right? You have that for the downside. And again, a put strategy is something you look at if you really felt that we're at or near all-time highs, or maybe you're thinking, wow, we've really rallied, I'd like to protect some of my portfolio. Maybe not the whole thing. Maybe just I want to protect 50%. Well, then, again, you'll put the appropriate number of puts in there to protect that portfolio.
So in addition to your May 9 seminar during the Singapore Investment Week, you're also giving us a workshop at a later time. Check out the SIW website for more details. Let's just wrap up then, Scott, with another view of the active versus passive. Because to be frank, when you talk to retail investors who are just starting out, they're all excited, they really want to get going, they want to pick some winners, they want to feel the rush of being in the market. You might have heard, and I'm sure you have, come across the so-called core and satellite strategy, where in essence you're not just saying, I'm going to put my money in ETFs, nor are you just saying, I'm going to put all my money into a managed fund or individual stocks.
Absolutely.
But you do both. Is there value in such a core and satellite strategy, or would you say, no, you should pick one or the other?
Absolutely there is. And most any money manager you speak with or financial planner will tell you that there are several, depending on your age, right, how close are you to retirement, your risk appetite, all these things. But a broad-based or diversified portfolio is not 100% ETFs, right? So again, there'll be a certain portion of your entire portfolio which will include fixed income, bonds, certificates of deposits, things like that. But a good portion of it will be in stocks, or what we call equities. And that's the portion I'm talking about that will focus on ETFs. Now, what else in addition to that? Well, ETFs, again, are not, like you said, extremely volatile. There's not the rush of trading. This is long-term investing, right? So when we're looking at ETFs, it's something we want to own for appreciation over the long run. And that's why that enhancement strategy becomes so important. When we're picking individual stocks, it might be just because we think Apple's coming out with the new iWatch, I want to buy 100 shares. Okay, that's a short-term trade, not necessarily a long-term investment. Because when you buy the ETF, you get some shares of Apple already, right? But if you think, well, listen, I want to load up a little bit more on Apple because of this news, that's more of a trade. So you'll always be having those kinds of things in addition to your long-term portfolios. So there's a place for everything, I think, in the big portfolio.
All right, thank you very
Okay.
much. Scott Connor from Think or Swim. May the 9th is the date. Go to the website on the screen to find out more.